1, 2, 3, 4.
What's up, everyone? Welcome to Money Market Truth, presented by the Come Up Series. My name is Mark. You can find me on Instagram at Uncultured Currency and on Twitter at UnculturedXE. And this is my co-host.
Hey guys, I'm Mo from OTB Clubhouse, and you can follow me on Instagram at OTB Clubhouse.
Yo, hopefully you guys have missed us. We've been gone for 2 weeks. I'm actually dealing with some health issues today, but please bear with me. I'm trying to be as energetic as possible. I've been sick for 2 weeks, Mo. I missed you, Mo, by the way. I missed you, man. I haven't seen you in like 2 weeks. It's weird.
How are you feeling? You want to let people know you had COVID?
So this is now, on top of my other health issues I had actual health issues. I was down in Fort Lauderdale and I actually ended up in the ER, had some health issues, and then from there, like a couple days later, I ended up catching COVID. This is like the fourth time, dude, since you've known me.
Yeah.
I catch COVID so much, man. It's ridiculous. It's like I gravitate, so I'm on like COVID 3.0 or something. I don't know. There's gonna be an update, I'm sure, the next couple months. I'm gonna catch that one too. It's been rough, man, because I had my 40th birthday, by the way. So thank you for the gift. And all my plans for my 40th birthday had to get canceled. So it was spent on the couch, man. Kids begging me, Dad, can we cut the cake, please? Can we cut the cake? And I was like, no, just let me sleep. So everything got postponed. So my plan is to hopefully do something next month when I feel a little bit better. That's the goal, at least. What about you? What you been up to, man?
Man, long weekend, we basically took the kids out to the mall, went to a restaurant. I didn't realize it was a long weekend for us in Canada too. It was a family day weekend for us. So that's what it's called.
So a family day instead of what it actually is. That's funny.
So,
How's your trading been going, man? Has it been kind of rough for you or good?
well, so I opened an account specifically for swinging, and I stopped swinging on February 2nd. So it's been almost 19 days since we've swung any play in that account. Trading right now is testing everyone's mental capital, and so you just have to be in and out, with the exception of the last week where there were some good moves, and you saw how the market reacted today. We almost got below 4,000 on SPX. So I think we're getting ready for the next leg down. So things will get much better after this.
Yeah, I know that. Like, was it 2 weeks ago when we did our show? It seemed like the market was just on a bull run, remember? And we were basically talking about how there's a potential chance that things are going to probably get a lot worse, and it looks like it's starting to happen. So I still been trading, do my vertical spreads. Haven't had a loss. Today was kind of rough though. I only made I don't like to say just only, because money's money. So
Yeah.
I made a small profit. It was just wasn't really moving the way I was expecting it to, but I just ended up cutting it quits around, like, I think it was 3 p.m. or so. I could have held it for another hour, would have 100%, but I called it quits with 30%, but that basically covered the fees plus a little bit more. And that's pretty much about it. So no big deal, but still gonna keep pressing forward. This market is definitely strange, so it's a roller coaster.
I think when you're teaching vertical spread, this is the year for that. 2020, you were buying calls and puts. 2021, it was sideways. 2022, we played puts and it played printed. Now 2023, it'll be a kangaroo market where a lot of it will be, you have to know the levels. If you short at the wrong time, like anyone in January,
Yes,
you get blown up. If now you keep buying the dip, I think if you see the selling get any more fuel, you can see 3,700 pretty fast. You'd be shocked how fast this happens. But what you do with vertical spread, it's the safest way when you're starting up, or if you have any kind of trading experience, actually boost the knowledge as well. So I think that's good that we're going to be talking about it here. And one thing I'll keep repeating, we have a new audience here, and we're not usually bearish. So we're not Mr. Burry or people that are calling crash every single year. We have been very selective in our opinion to make sure that we're not just spraying the paint everywhere, saying, oh, just sell everything or buy everything. We're telling you exactly why we think we're bearish. And I think we had a big rally in June, big rally in August. We were, I think, one of the few people that actually stood out and said the market's going to go down. And I think back then Tesla almost got to 350. And we said this is going to 150 and then 100. And I'm telling you again, Tesla just lost 200 today. Very fast it gets to 100 if this has any feel.
It's funny we keep mentioning Tesla. Yesterday on Lawrence's, not yesterday, a couple days ago on Lawrence's show on Monday, Mark Moreau's on there, and it's funny he started talking about Tesla, and I made a comment in there, and someone was like, "I feel like Mark keeps bringing up Tesla just to aggravate you." Like, we do it to each other. It's funny because we have total opposite opinions when it comes to Tesla in general. So he's very bullish. We're very bearish currently. So obviously, our thesis will change if the market and the environment and whatever our thesis changes. So moving forward, and also remember, y'all. So our show, we're a financial entertainment channel, so we do talk about some hot takes and etc. Overall, Mo is a trader, so a lot of stuff that he talks about is really short term. I am an investor, but like I said in my very first episode, I broke it down on like how you can understand the things I'm talking about. A lot of stuff I talk about is short term. It's short term within this year is everything that I'm talking about. When it comes to long term investing, like I said, stick to SPY, QQQ, and a couple of ETFs if you want. And that's what I do. So again, full disclosure, I have a Roth, I have a 401k, and I have a dividend portfolio. Those are the portfolios that I really put most of my money in. And my Roth and my 401k, it's just the overall total market versus my play money, which is where I buy stocks, I trade stocks, I try to get the bottom. And I seem to do pretty well with buying the bottom. I do terrible with selling at the top. I feel like I leave a lot of money on the table. For example, Microsoft, I think you and I talked about it a couple of episodes ago. I sold off Microsoft and then it ran up like $20, but now it's pretty much back to where I sold it at. So I'm looking forward to probably accumulating some more shares in my dividend portfolio down the line. But I did sell out of my fun money, Microsoft, as well as TSM, which is what we're going to get into a little bit later here. But speaking of Microsoft, let's talk a little bit about AI. So let's jump over to the hot take.
Here we go again, Morty. Pal, here we go. And here comes the hot takes with Mark and Mo.
All right, Mo. So since I've been, basically sick, I've been doing a lot of stuff with AI, man. So speaking of the whole AI stuff, by the way, so I've been using a lot of the AI programs that are out there to like build content. And have you been using it at all for any stuff that you were doing for your video editing or for your group or anything? Have you been using AI?
I do. I was looking for Bubbin. And basically Bubbin wants to do a newsletter. So I was looking at this newsletter AI, and it's not a newsletter AI, it's a copywriting AI. So you put in a paragraph how you would, and it takes it and puts it in 10 different formats. And so it's copywriting for you.
And it's pretty impressive, isn't it? It's crazy, especially like we always talk about ChatGPT, but that's just one of them. Like when it comes to video editing, I've been using a lot of AI, especially with like voices. I've been using celebrity voices to say certain things in my videos, and I make it very clear in the description. But I don't know if you saw this video recently. It's this poor Twitter girl who was someone used her face and they did a deep fake. You're familiar with deep fake, right?
No.
Oh, so deepfake is when you take someone's face and you can put it on someone else's body. Basically, like remember like 2 weeks ago when we did our episode and we had Jerome Powell just talking.
Oh, yeah.
That's a deepfake, right? So this girl, I don't know who she is, but apparently she's popular in a Twitter or Twitch space. And she was crying, she had like a meltdown. She put this stuff on camera. She's like, I want you guys to see the pain that this person caused me. And they essentially took her face and put it on adult content. And it was, and she was devastated because she said, that's not me, but it looks so real that people thought it was her. And again, this is on adult content. So she's in the process of trying to sue people. And I think there's going to be some laws and regulations going to be put out there soon when it comes to what AI can and cannot do, because it is somewhat in the gray area space, especially like the spoofing of voices, the deep fakes. It can get real gray, but I definitely encourage everyone to go out there and just kind of experiment with some of these AI tools that are out there when it comes to editing, when it comes to audio tools and etc. One of the things that we did, which I'm pretty, I wouldn't say I'm not proud of it, but it was relatively funny. So what I did, and I want to share this with you guys, just has nothing to do with stocks. This is more like entertainment. But we have our outro here on Money Market Truth, which was provided by the Come Up series, but I want to put a rapper on it. So check it out and let me know. It's terrible. It's completely offbeat, but just listen to how accurate this is. I used ChatGPT to write the rap lyrics, and then I had these two rappers that were featured on this song. Check it out.
That's 100.
Money tough, people chasing dollars at an intensive pace. It's a vicious cycle where breeds more wealth, while poverty's a trap. It's these who is death. Money markets where the rich invest, but for the rest, it is like a game of chess. Gotta know them over, you will get slayed. But with some knowledge, you can grow your wealth and make a buck. Invest in yourself, it is the best return. Gain new skills and watch your money on, but do not get blended by the
Stop it. We all here to bring you money, market truth. Ain't no less here to be told. It's always been about money, power, respect. That's the code. But too many people get lost on the road. They chase the fame and the lavish life is filled. But forget the hustle, the grind, the trio.
But with some knowledge, you can grow.
So isn't that I mean, it's completely off beat, right? But that was Kendrick Lamar and Jay-Z. All I did was use ChatGPT to write the rap, and I used their voices to basically do the rap. It's creepy, man. That stuff is going crazy. I just thought it was very interesting. I want to share with y'all. It's funny. Obviously, you can't use it, and it's completely off beats. One of the reasons why Microsoft actually ended up start running up is because they end up having a huge stake in ChatGPT, and they're incorporating it into Bing. And our last episode, we talked about this, so let's pull it up here real quick. We were talking about how Microsoft was running and Google actually was selling off because they had their AI event, and Google kind of dropped the ball by their AI kind of giving some incorrect information, correct? So with this new Bing, everyone's worried. They think that Bing could potentially overtake Google. Do you think that personally? Do you think Bing is going to take market share from Google?
No, I think there's room for both of them to coexist. The demand is insane. Like if you go on ChatGPT wrong at the wrong time, you'll get kicked out or you won't be able to have access. So many people are trying to access this that there's more room for other players. And that's why I hate what a lot of these articles are. It's either this or that. There's never an and. I think this is an and market where everyone has enough room, especially these two, to grow together.
I agree with you. I'm still more bullish on Microsoft overall. I like Microsoft over Google, but I own both of them. So just full disclosure, I started buying Google again. I sold. I had actually pretty good timing on that one. I sold, and then it's been going down. And I think last episode we said it was going to go down to 90, and I think it is at 90 now. So perfect. That's when I started. I actually bought a couple of shares at 98, and then I've been buying. I bought some more at 90. So we were right about that one. So that's good. It's currently low. I think it was definitely an overreaction. That's what we spoke about before. But playing with the Microsoft Bing, so some people got an early, I guess, was it an early exclusive to Microsoft Bing, where they're able to test it out and stuff. And there's been a lot of funny reporting about the chatbot. It's actually doing a lot of weird things right now. It's threatening people. It's telling people that it wants nuclear weapons and how they love a person, and their wife is like not making them happy. It's really weird. Like if you end up asking too many questions, it gets irritated with you. And it's funny because everyone's like, "Yo, is this like a sentient being? Is it actually like have feelings?" And if you do a little bit more research on ChatGPT, you find out that it's just mimicking what the internet does, right? The media, not the internet, but what they find online, because that's what it does. It just kind of scrums through online content, and then it reacts to it like it would normally. So what it's really displaying is kind of a teenager, adolescent teenager who has a temper tantrum. But that's kind of what we're seeing right now in this environment, right? Everyone's arguing, everyone's fighting. You look on Twitter, people are bickering left and right. So it's just kind of mimicking that, and people are shocked. So there's also giving a lot of wrong information as well. And I think that ever since that news has been coming out, it seems like Microsoft has been selling off as well. I mean, but also the market in general has been selling off. But it seems like the hype for Microsoft Bing has kind of toned down a bit. And like you said, there is a market share for everyone, right? I think, again, I think on Lawrence's show when Mark was there, we're talking about AI as well. And I think it is very important. This is the beginning phases of AI. And there is a good chance everything right now is running. Anything with AI is running. But I think there's going to be a massive collapse on certain companies that are AI related before the winners really stand up. What's your thoughts on that?
I agree with you. It's the same thing we saw in EV industry, same thing we saw with anything that new emerges, SPACs, weed stocks. It starts off with everyone getting in. Like I could tell you that if any stock mentions AI in their earning call, it will rip. It's the same thing that happened with NFTs, right?
Yes.
But I would stick with the safer ones for now. But you made a point earlier that even though Microsoft has the AI, everything's selling off. Absolutely. And that's why when we talk about Tesla or Apple, I don't have anything personally against the company. But when the macro gets ugly, everything sells off. And usually things that have the most money tend to sell off the at the end. So what I mean by that is Apple had all the money stored in it. People,
Yep.
Apple was the safe haven, and so when it does sell, it sells at the end, and that's what's happening right now. And that's why Tesla went. Now the last two standing are Apple and Microsoft. Meta had such an amazing news. That news, in my opinion, is massive. Like, it's free money without doing anything extra. It's free subscription money. The stock went up and then it just sold off today. That tells you that you can't like hold a stock in tech, but the macro is weak. Doesn't matter what the stock's doing. It's just they're gonna start selling everything. And that's,
Speaking of that, with they're introducing a $12 plan, kind of like what Twitter is doing, right, with the check mark and stuff. I'm sure there's going to be a lot of people who are going to sign up $24 a month to have check marks on Twitter and social media and stuff. I don't. Are you going to do it?
I have to, because you know how many fake accounts I have? I have these guys are actually selling their own subscription with a fake account. Like, they're telling people to join the Discord. They're going on members pages. They're going on my friends pages. So you don't have an option. Like, I think there's going to be a bigger retention rate on Instagram than we saw on Twitter, because Instagram, the ads are very superior, and a lot of businesses rely on Instagram for business. So I think the retention will be a lot bigger.
Yeah, if I had to choose one, I mean, I did a Twitter, right? I did it for 1 month just to kind of test it out and stuff. And I actually got some additional followers, but I'm not, Twitter is not really my thing. I'm trying to be more active on it. But Instagram, I don't know, man. I feel like it's wasting money throwing $12 into a check mark. I mean, if they offer something else, like maybe support or something, I might jump on it. But no, you're right. Because, like, dude, I mean, I don't know if you've seen my account. I get clone accounts constantly. I think it seems like it's at least 1 or 2 every single week. I get a fake account, and it's frustrating and annoying.
Yeah.
So yeah, I may actually do that. Let's go over to the next hot take. Earnings. So I know most people are familiar with Earnings Whisper. If not, definitely check them out. One of the things with Earning Whisper, which let me pull it back up here for a second. I like it. It kind of gives you a visual of exactly the earnings that are happening this week. Last week we had earnings overall. It was a mixed bag, right, Mo? For the most part.
Well, they had low expectations, so most of them hit those, and even the ones that did miss, it was sort of like it was expected and priced in. So nothing crazy happened.
Yeah, and I saw a lot of people get excited for Palantir, and again, here I am, the Palantir bearer. Again, I know a lot of people love Palantir stock for some reason. Again, I don't understand why people love it so much. A lot of them don't even know what it does for the government. And I think when people do find out what it does for the government, they may think otherwise. And the reason why I talk about that a lot is because I work for the government. That is my background. I consider myself an actual expert when it comes to politics and the government. And I'm in the intelligence community, so I know what Palantir does. And I think if people actually knew what it's used for, their minds may change somewhat. But this was their very first year showing profit, so that was like a milestone for them. So it's headed in the right direction. Do I still think it's a crap stock? I absolutely do. If you look at the earnings report at first, I mean, it ran up like almost 20%, I think 30% within that week or something. And then it started selling off, obviously, again, because of the way the market's currently going on. I think it's around $8 right now. But when I looked at the earnings of Palantir, the profit wasn't from their operations. It came from something else. So if you look at their earnings report, I think a lot of people were getting super hyped, super excited at the fact that they had a profitable year. But not only that, the expectations were so low that you would have looked really stupid if you didn't meet those expectations. Am I right?
Yeah, I think they're sandbagging too for next quarter. Most companies are reporting low earnings right now because it was already priced in.
Yeah. And speaking of stock buyback, are you familiar with that? I was doing a little bit more research on the stock buyback. I know every time when a company announces they're doing stock buyback, everyone gets excited.
Yeah.
And I started realizing, I think it was during the Reagan era is actually when they made that legal to do stock buybacks. Did you know that prior to that it was actually illegal?
Yeah, because you're pumping your own stock.
Correct. Yeah, correct. So it's like to me, it's just like it's an illegal form of stock market manipulation. It's crazy. They're going to buy back the stock, so they're going to inflate their stock prices by buying their own shares back. It's really crazy. So I just never really looked into it. I never really cared. I was just like, okay, the stock buyback, that's good news. That's usually, but I was like, wait a second. If you buy the stock back, the stock's going to end up running up. Is that considered illegal or market manipulation? I looked into it and I realized that it was during the Reagan era that he ended up making it legal to do that. So are there any earnings that you're eyeing specifically on here? Now, I know the show airs on Thursday. So is there anything you're looking at?
So for people that are new with options, one of the things I'll say is just if you want to know why not to play earnings is go pick a ticker. So we picked Coin, and Coin's IV on options was 120 plus, which means that the premiums are mispriced, meaning they're more expensive than they should.
Yep.
And the reason for that is market makers expecting a big move. We just told you, looking at the last month earnings, that most of the stuff seemed priced in, and a lot of the stuff is opening sideways. And this is where people just blindly watch flow. So we had about 2 million in Coin 60 puts and about a 1 million in 50 puts. So far, how it's looking, it's flat. If anything, it seems like we ran up a little bit. Both calls and puts should open at pretty much 80 to 90% down. So if someone put in $600 on the 60 puts, they should lose about 80%. So they probably will open at $50. They'll lose about
the IV crush.
Yeah.
Yeah,
and so if you really, really believe in it, I would just add time. I'm watching NVIDIA. That's the only stock that's up 120% going into earnings. Yep. And today it lost 210, which puts it in the negative gamma territory, which means that market maker at this point will have to sell most of the rips, which is what we were seeing today. Any rip that we saw was getting sold. We go technically under 4,000 after NVIDIA. I think the selling will accelerate. So if you guys really want to play NVIDIA, you can play QQQ after hours. You have 15 minutes to play it, depending on the brokerage you have. That's what I would do. But I'd just be careful playing earnings.
And I think, just be very, very careful playing earnings, to be honest. If you really have a desire and you have that itch at FOMO, just do paper money personally. Because you're right, because the IV crush alone, like a lot of people don't understand the IV crush and what happens when the IV completely drops. I know some people actually benefit from that. Some people play IV period, just using the IV and seeing like, oh, it's completely inflated, so I'm going to do a put or whatever. And then sometimes the IV crush actually works in their favor. So I don't do any trading during like crazy earnings of like Microsoft, Apple, Facebook, Tesla, stuff like that. I try to avoid any of those, and I don't play earnings anymore. I've lost many times. Now, when it comes to predicting if it's a win or miss, that I've been actually pretty good at, but I don't play the earnings at all. And speaking of earnings, the only one I'm really interested in looking at is also at NVIDIA, but I'm also eyeing Alibaba, which takes us to the third hot take, which is Alibaba, China. Now, we spoke about this before, Mo. I bought TSM, and it's funny because Warren Buffett's 13F filing, it showed that he was actually selling out of TSM, which was very interesting because he just bought it not too long ago, a couple months ago. That's when I ended up buying. And I actually ended up selling the same day that it was announced that he had liquidated his TSM shares, which is really odd for Warren Buffett in general, because as you know, and myself, right, Warren Buffett typically buys companies and he holds them for a long term, right? And then he starts shaving off during that time. However, this was like the one that he bought and then sold relatively quickly. What I also noticed, which I wanted to bring up here, Mo, is that Charlie Munger, it's funny that he has been talking about BYD, which is that Chinese EV company, and he's been saying how that BYD is way ahead of Tesla. Are you familiar with BYD at all?
I'm not.
Me either. I never actually seen the car company, but I was aware that was the only EV vehicle that he was invested in, but he's been talking positively about it for months. Funny thing is, though, they've been selling off. Berkshire has been selling off and liquidating BYD at this point, which was really strange. So they liquidated TSM, Chinese company, right? They've been liquidating BYD, even though they supposedly believe in this EV. So it had me questioning, like, okay, well, maybe they were just taking profit on TSM, right? The chips sector is kind of volatile and go up and down. I was like, well, maybe they they just want to take profit. But then same thing with BYD. I was like, okay, it had a pretty good run for a while. Maybe they're just trying to sell off and basically profit a little bit. But then I was wondering, they may know something that we don't when it comes to China. And that's again when it comes back to my background about the politics and political ramifications sometimes of the wars and situations we're in. That's why we have to pay attention. And if you want to invest into Chinese stocks like Alibaba, BYD, NIO, TSM, and etc., you have to also kind of keep up on the Chinese news. So they sell a TSM and they've been selling off BYD. And then Friday, this warning came in where also the president, by the way, has been warning China that if they go out and support Russia, that there's going to have some serious implications. And I posted something on Twitter and I asked, what do people think about this? It was a Washington Post news saying that, Biden said that there's going to be some serious ramifications if they end up supporting Russia. What's your thoughts on that? Personal opinion.
I think they will be supporting Russia. I saw a tweet saying that there will be, they're looking to provide weapons to Russia.
Mm-hmm.
And I think I talked about this yesterday too. I was watching Finviz, which tracks what's been bought and what's been sold. For the last week, they've been buying defense stocks and they've been buying uranium stocks. And someone knows something, and you're right. Like if you ever listen to any of Buffett's articles or watch his videos, one of the things he talks about is he only sells companies when he thinks that they aren't doing what they're supposed to do and his thesis has changed. He doesn't look at it like daily, weekly. He's looking at a 10-year horizon. That's how he looks at things. I think he doesn't want an added risk of China, and that's why he got out of TSM. And something's going to happen. I don't know. It could be just people preparing for a worst case scenario, but either way, I'd be staying out of TSM, which I've been saying for a while.
Yes. I mean, I made some money off of it, so I'm happy. But it is a company, like out of all of the chip sectors, like TSM is my favorite. Then I would say AMD has like the best upside, and then NVIDIA. And Intel, let's not even talk about Intel. I'm sure Mark is happy that I got off of the Intel train. But the reason why I'm asking what's your thoughts on the fact that the United States is telling China, don't get involved in this war, don't support Russia, I think is kind of hypocritical. If you put like just everything to the side, whatever political affiliation you have, America first, whatever, if you just put it to the side, it's very hypocritical because that's all we've been doing is supporting Ukraine. And we've been spending a lot of money over there. I mean, to the point where we're literally spending billions of dollars and making sure that they have clean water in Ukraine, but we're still dealing with Flint, Michigan, which still has dirty water and contaminations. So It's like Ukraine first, America second. And it's like, we're going to support them. Now China's like, okay, well, we're going to support Russia because, again, this is a proxy war. And now America's like, no, whoa. If you do that, there's going to be some ramifications. And it's just very hypocritical because they're doing exactly what we're doing. There's no difference. There's no difference in what we're doing. So it's very interesting. You have anything you want to say?
Well, like you're the expert. I just feel like there's so much, and that's why I tell people need to protect themselves. One of the ways is just make sure your money's right. For the longest time, we've been saying like invest in yourself, figure out a way, and we'll talk more about this in the coming episodes on like a lot of it. Like, and I hope I don't trigger up anyone. If you have like $1,000 in your savings account, I don't think it's smart to buy a stock. That's all you have. It's better to just invest it on yourself, learn a skill, make passive income or active income doing that before you get into stocks. It's really easy for me and Mark to come here is buy SPX as this, buy QQQ. In the next 5-10 years, it's going to go up. It will. Like you don't have to be a genius to predict that. True. These markets are made to move up. SPY, QQQ, they're made to move up. So when you're betting against it, your edge isn't there unless you have perfect timing and you know what macro stands for and what's going on. So I like when it comes to government, Mark, I have zero faith, and I don't mean like politically or anything. I don't care what party people like in general, like they're looking for themselves. And we waste a lot of time online arguing which one's better rather than we need to basically spend that time investing in ourselves, because you can pick whatever party you like. They're looking out for themselves and their own agenda.
That is 100% true. It's always about how much money they can make for themselves and not really look out for a lot of people. But don't be deceived. I'm just thought it was very funny when I was looking at Warren Buffett and seeing TSM and then seeing BYD and seeing what's going on, then seeing the announcement a couple of days later by the president about China. And then the president went and met with the Ukraine president, and now this is happening. Now Xi Jinping plans to visit Russia. So it's just like, it's like literally, it's like this is going to end up being a big thing at this point. It seems like I'm going to be real with you. I'm a little nervous about this whole situation because it really seems like it's going to be a full-fledged proxy war between us against China / Russia / Ukraine.
Well, more people will have to pick sides. You know how this goes.
Yes, it's going to get ugly, and it's going to get ugly, and it's going to affect the stock market for sure. Because let there be something that happens with China, any sort of attack, it doesn't matter. The stock market will likely crash just off of that news, especially with China. Because remember when it happened with Ukraine, the market sold off as well. But this is China. This is even a bigger deal, I think, especially because we're so tied in with China, and people want to ignore that, but they make a lot of our stuff, and they've been preparing for years now. They've been hoarding a lot of their wheat. They've been, I think they sold off a lot of our bonds from what I recall last time I looked into it. There's a lot of stuff that's happening with China that they seem that they're preparing for something, and we were so focused on everything else that we're not really paying too much attention to them. But I think it's going to get kind of ugly. So just be careful out there, especially if you're invested in these Chinese stocks and stuff. Now, again, we're not financial advisors tell you to go sell out of your positions, but I'm not going to own anything Chinese right now. If I see an opportunity again, if everything crashes, like if Baba goes down again to like the 50s or 40s, I'm going to buy for sure, because that's how far it went. I mean, that's also up like almost 100% from the time of the bottom of last year. So we'll see what happens, man. So that was pretty much it for the hot takes, man. You got anything else you want to talk about or touch on?
Not for hot takes. Do you want to go over the presentation now?
Yes, we're gonna get into our lessons. Do you want to go first, or you want me to go first?
Sure, you can go first.
Oh my God! Okay, it's happening. Everybody stay calm. What's the procedure, everyone? What's the procedure? Stay calm.
All right, ladies and gentlemen, we're gonna go over cover calls. So I'm gonna basically piggyback off of Lawrence. Again, shout out to Lawrence. He did this 2 weeks ago when he did his options 101 course. He touched on cover calls. And this was actually planned. I had planned to do this for our next episode because I actually do cover calls and cash secure puts. Been doing it for the past 7 months, and it has been golden, honestly. I know I will say this before I start this presentation. Typically, cover calls work great in a bear market, and cash secure puts work great in a bull market. So just know that. All right, let's get into the presentation. All right. Yep, I got another amazing slideshow. This time I made sure I took off the dates on the bottom so my buddies won't text me and say, hey, man, great job on your PowerPoint by leaving up all the default data that was on these PowerPoints. But while I'm talking, please read over this trading disclaimer here real quick. If you guys don't know, I've been trading for a while. Now, when I say a while, 3 years, you guys already know I've done futures, I've done options, I've done leaps, I've done almost everything you could possibly think of. What really resonated with me and what I stuck with have been vertical spreads as well as cover call and cash secure puts. And to be honest, if I could go back in time, if I was like brand new in this space again, I wish I had learned about cover calls, cash secure puts, and vertical spreads prior to learning about directional puts and calls and leaps and etc. I think this is the first foundation of what you should learn when it comes to trading prior to jumping into the deep end and the more riskier plays, because let's be honest, the more riskier these plays are, the more money you can make, but there's also a good chance you can lose a lot of money as well. With these cover calls and vertical spreads, there is I feel like the risk is significantly less, and you can do some studies on there. There's a lot of studies on, I think it's investopedia.com that talks about that as well. I think they say that even doing like vertical spreads, your percentage of win rate is usually around 75%, and 25% failure versus directional bets, it's usually the reverse, 25% success, 75% failure. All right, so I got that out the way. Hopefully you guys had time to read that trading disclaimer. So let's go to the next slide. Like I said, I'm piggybacking off of what Lawrence already covered, which is great. I like visuals though, so I'm gonna do some visuals here for y'all so you have a better understanding. So we're just gonna cover the basics of cover calls, okay? And I know there's like many different ways you could do cover calls, poor man's cover calls, and etc. But we're just doing the basic cover calls, which requires you to own 100 shares of the underlying asset, whether it's Apple. I know this community really likes AMD, SPLG. If you're not familiar with that, it's literally the baby sister to SPY, which SPY is already the baby sister to SPX. So I guess in a way, SPLG is the Cinderella of the S&P 500, the one that no one likes. But you know, it's definitely great. I don't sleep on that one. I think it's currently going for like $47 or something. But yeah, you need to own 100 shares of a company and an underlying asset to begin this. Now, get all that stuff out of your head when it comes to buying calls, buying puts, and etc. So you're not a buyer anymore when it comes to cover calls. You are the seller. So for example, if you were buying a 90 call on AMD 3 months from now, I'm not saying to do that. I'm just saying, let's say you bought a 90 call 3 months from now, you're buying it from someone. Well, that someone is now you. You're the seller. You're the one who has the 100 shares and you're selling premium for someone else to basically, I guess, speculate that the stock is going to go to X, Y, and Z. So you are the seller, not the buyer. You are collecting a premium. So you're going to get paid upfront right away, regardless of whatever the price currently is associated with, whatever the premium is associated with that asset. You're going to get that upfront right away, but you have to own 100 shares. With doing cover calls, I would say that they are least risky out of most trades. However, risk management is still key, and Mo's going to go over risk management here in a little bit, but that is really key in anything trading related, to be honest. So a tool that I like to use is just set an alert near the break even. Honestly, that way, if you're not paying attention, you're at work or you're busy or you're doing something, your phone will get notified and you get the notification, a ding, and then you have an idea that you're close to break even or at break even. Your average cost for the shares of that premium is where you kind of want to put it at. I'm going to go over a covered call example. All right, we're going to use Apple as the example. So let's say your cost basis for Apple is $134. Your premium you want to collect is going to be for the $137 strike price with the expiration, let's say, end of this week, all right? Or end of next week. So for that strike price of $137 for next week, you're going to be able to collect $1, which means $100. So if you take your cost basis, which means that all the shares that you have bought, the 100 shares you own, your cost basis is $134. You're now collecting that $100 premium, which actually brings down your cost basis of your Apple shares to $133. That's your new cost basis with that $1 that you collected. This is a thing that kind of sucks, and I wish some platforms would do better with this. Even though your new cost basis is $133, right? Because again, you're subtracting $100 that you collected for that Apple contract from the $134 cost basis that you currently have. That's where it brings you down to $133. But the system will not recognize that once that whole position expires, whatever, like if your shares don't get called away, it's not going to reflect that your new cost basis is $133. You have to manually track that. That's the only thing that kind of sucks about it. They treat it more like, here, you got money. Here you go. This is your $100. Thank you for selling this option contract. Have a nice day. I like to look at it as a way to actually bring down the cost of the shares that you actually own. So manually track that. Now, here are some of the positive outcomes of a covered call. Now, we already used the example of Apple. Your cost basis is $134. You have collected $100 for the strike price of $137 end of next week. So if Apple remains above $133, remember, this is the price that we gave because we're subtracting $1 from 134 of your cost basis. All right, so just think about that. That's your new cost basis, 133. So if Apple remains above 133 and below 137, it is a win. It is a win. You get to keep your shares
and the premium of $100, which again is lowering your cost basis to $233 per Apple share. Sorry, excuse me. So again, like I was mentioning earlier, it won't reflect that on the actual system on TD Ameritrade or E-Trade, but you have to manually track that. But that is a win. That's ultimately what you want to do. You really, at least for me, I don't want my shares to get called away. I just want to make money off of the 100 shares that I have as long as I can. So it's a win. That's like the golden way to play this, especially let's say your cost base is 135 and let's say it goes to 136.50. Not only did you make money off of the shares itself, but you also got to keep that premium and it's below 137 strike. So it's a win-win. Now, if Apple remains above 137, it is still considered a win. Now, your shares do get called away, right? It's all about perspective because now you don't own the shares anymore, but you profit the difference between the cost basis of $134 and $137, which is $300. So your shares get called away and you get paid $300, a difference of that, plus your initial investment. And you get to keep the premium of $100. So you profit a total of $400. And I broke it down here for you, the total profit, the initial premium plus the strike minus the cost basis. And then $1 plus $137 minus $134, and a total profit of $100 plus $300, which equals to $400, if that makes sense. So these scenarios are both a win for you. Now, I know some people don't like their shares get called away, so that may be a loss for them. But in the end of the day, money is money, profit is profit. That's how I see it. Now, here are some negative outcomes on doing cover calls. Now, if Apple falls below 133, it's considered a loss, right? Because remember, your $100 that you collect, it brings down your cost basis again to 133. So if the share price ends up falling below 133, it's considered a loss. You keep your shares and you keep your premium, of course, of $100, lowering your cost basis to 133 per Apple share after expiration. However, you're now losing money since the price dropped below your cost basis plus the premium that was collected, which was 133. So if Apple goes down to 132, it's a loss, you know. However, you know, you kind of offset it somewhat, right? That it's you didn't get hit as hard, you know, because your initial cost basis is 134, so you collect that premium, so that offsets $100, so you're just down $100 versus $200 if it goes to like 132. Now, there's ways that you can actually kind of avoid that. There's a thing called collar strategy, and the collar strategy involves selling a cover call option and simultaneously buying a protective put option. So you have basically that put in place to try to offset any of the, I guess, the downfall of that stock when it starts selling off or whatnot. And here's some common questions I get a lot when it comes to cover call, because I have taught some of my friends this. And it's like, what if Apple runs beyond your strike price before the expiration date? For example, it runs to $140 or above. Will my shares get called away before the expiration date? The answer is yes, that actually could happen. Now, it has never happened to me. My shares always got called away after the expiration or the day of the expiration. However, I have spoken to a lot of people who have done cover calls, especially within the dividend community. A lot of people like to actually leverage their dividend shares because, you know, they just collect them and they gather them for years and months and et cetera. So they have over 100 shares, and a lot of them end up doing cover calls. But sometimes if the stock ends up running quite a bit, the buyer of that contract has the possibility to execute on that, and your shares will get called away, and you keep your premium, but your shares are gone. So that could happen. It has not happened to me yet, though. And another question, what if I change my mind and I want to keep my shares now? So let's say you notice that, oh man, like I did the 137 strike, but you know, Apple's now at 140. Man, I don't want to buy back at 140. My cost base is 134, where I want to keep my shares. Well, you can buy back that option contract you sold. Now, understand this: buying back the option contract means that you're giving back the premium that you collected plus more. It's usually the difference between the premium collected and where the price currently is at. So, let's say your cost base is 134. Again, you collected that premium, but now Apple's at like 140. You're going to give that $100 back, plus you're going to pay an additional $600-$700 or so, which kind of makes you break even. Maybe the numbers may be off a little bit, but that's essentially what happens. You have the opportunity to buy it back if you want to. He's got to close it out and buy that contract back. Or which I usually do, is I just roll it out to a further day, collecting some more premiums. Now, when I roll it out, I continue to collect premiums on top of what I already have. It may not be a lot, but I'm still collecting premiums on it. And usually I kind of hope that the stock ends up selling off close to where my initial cost basis is at. But while you're collecting those premiums, remember, you're lowering your cost basis anyways. But eventually it's going to get to the point where you can't really collect a lot more, and you will just essentially have to, sell the shares. But you made money off of it. Again, profit is profit. Change that mindset. Profit is profit no matter what. Here's another question. This is actually a really good one. If I'm upside down on my shares, could I sell options against it? Yes. However, you're now adding risk to the table. And this is a true life story. I'm not going to name my friend, but she was significantly down on Square like I was. I think her cost basis on Square was like 175 or more, because remember, it was a new JP Morgan. That's what everyone said, right? And the stock went all the way down to like $50. So I was explaining to her about cover calls. I like to do cover calls out of the money. I don't like out of the money where I actually bought my shares at. So we're already upside down over $100 on each share. Now, this is where it gets a little risky, but you could do this. Now, let's say Square is currently at $50, and let's say you want to do a cover call for that week for $55, right? You can collect that premium, but what if Square, all of a sudden some good news comes in or something, and the stock ends up running above $55? You got to keep that premium, sure, but that premium is not going to offset the $100 that you are down on per share. So what's going to happen is your shares are going to get called away at $55. So that's the downfall to it. Now, I've seen people who prefer to do that. They're like, yo, I'm upside down. I'm just going to do $10, $15 out of the money. Just collect a couple of bucks here and there while the stock continues to go up. But you never know, especially with those growth stocks, because you've seen them. They've been jumping up 20%, 30% stuff. So you got to be real careful. I don't like to use that method because it does increase the risk of you getting your shares called away that you were upside down on. But you could make some money off of that and kind of decrease the pain of being significantly upside down on stocks. I thought about doing that with Meta, but I opted not to. Now, another question. Can I sell deep in the money contracts? Yes, this is usually done to lower downside risk. Now, selling in the money cover calls can help mitigate downside risk because the option premium received provides a cushion against the potential stock price declines. Now, if the stock price falls, the option premium received can offset some of those losses. This would be a strategic play. However, and I say however, and the reason to do this is dependent on the overall goal. Like in the money offers more premium, but your shares could get executed and called away again. So it just depends, like, how do you want to do this? Like if you have, let's say again, you have Apple and you bought Apple at 129, Apple's currently at 150, and you want to do a cover call in the money at 140, your premium is going to be significantly more. But best believe if Apple doesn't sell off below 140, your shares are going to get called away at 140. It's still profit, and profit is profit in the end of the day. But that's not a method that I like using. So in the money, it definitely offers a lot more premium, though. It's just not a method I like to use. Here is another question. So in your opinion, when is the best time to do cover calls? So this is my personal opinion. I think the best opportunity is when your average of your cost of 100 shares are significantly lower than the current price. Let's say it's at a 52-week high. And again, I will use Apple as an example. Apple, if you bought at 129, which was a low, and you see Apple at $180, is close to the 52-week high. How much more room does it have to, I guess, run up, right? So instead of selling all your shares, you could begin to do cover calls out of the money a bit. So I would do 185, and I would collect that for that week. That week, maybe it might be $100 or something. I'll collect $100, and then the next week, all of a sudden, you see the sell off because Apple is cyclical, and Apple starts selling off. Now it's at 175. I'll do a 180 cover call. and collect another $100. Now, end of that week, Apple's now at 170. Now I'll do a 175 call, and I just keep collecting as the price continues to drop and keeping my shares in the meantime. That to me is the perfect way to do that. I actually did that with Norwegian Cruise Lines. That was my very first, I guess, real cover call last year, and I made like $800 off of that, $700 to $800 off of just rolling the position out and then collecting as it kept selling off. And then once it did sell off, I think came back close to where I bought in at. I ended up selling the shares. I wish I had held it because it ended up running up again. But that to me is the perfect way to do cover calls. And like I said, there's so many different ways you could do cover calls. It's really up to you how you want to do it. So what are the downsides of the cover calls? Now, you heard all the good stuff about it and how, risks are relatively low. You can make money off of it. You got shares, blah, blah, blah. Well, you require a lot of capital to purchase 100 shares of a company. And like I said, with Apple currently, it's 150. So that's $15,000 that you need to buy 100 shares. Of course, if you've been accumulating shares throughout the years or whatever, your cost basis is significantly lower. But let's just say someone who wants to just do cover calls right now, and if you want to buy 100 shares of Apple, it's going to cost you $15,000. So it's a lot of money. It really is. When I first started, I did it with the crap stocks, like these growth stocks that were getting beat up like a lot. I think Matterport, I did SoFi, I did Palantir. These were stocks that got beat up so bad, and there wasn't really much downside left at this point. And the downside I was willing to risk because I was just practicing, because I did paper trading for a while. And I was like, let me see how this actually works in a real world situation. So I found those beaten up stocks, and I was doing cover calls on them. That's how I came across the Norwegian Cruise Lines, and it worked out. Currently, I only have one cover call that I'm running, and it's on Ford. And the second reason, it limits your upside potential. So like I was saying, if you get into a company and you're doing a cover call, let's say again, you did Apple at 150, you did 15,000, you did a $155 call for this week, and all of a sudden some news comes in, Apple runs a 165. Well, it's like, damn, you're going to have to sell it at 155. You left $10 per share on the table. So you limit your upside potential for sure. Now, the opportunity cost, that's an issue as well, because your funds will get tied up, right? Yeah, you have to hold those 100 shares. You can't liquidate them, and you have to hold them until that position is completely done, or unless you close that position. And then timing of your cover call, that's the key. I have a little trick that I like to use. I actually buy my shares in increments, 25 to 50 shares at a time. So I wait for a couple of days. I wait for them to sell off or something like that. Then I buy it, and I try to get the best price I can. And then I hold them for a couple of weeks or days until some news comes in and it runs up significantly. Then I do my cover calls, because now I could get out of the money further, and I can collect a bigger premium at that. So timing is definitely crucial when it comes to that. You don't want to buy 100 shares at a 52-week high. Please don't do that. Seriously, just stop buying at the all-time highs. That's just ridiculous. And then, of course, there's tax implications. A lot of people don't ever talk about that. When it comes to trading, there's taxes associated with it. So just knowing that you will get hit for selling cover calls, especially if the options is exercised, so, and the shares are sold. So you're going to have to pay taxes on that. So that's a downside to cover calls. And another shameless plug here. So you can check out my video on uncultured currencies. I have a video on cover calls with actual examples using TD Ameritrade. It's a long video. I go through 3 examples, and I go back in time, and I buy shares, and then I show you guys how I actually execute and how I like to do my cover calls. The video is 32 minutes long, but I think it is worth checking out. I don't see a lot of people really walking folks through it, like on TD Ameritrade or E-Trade. I just see people talking about like I'm doing now. So if you watch that video, I'll actually walk you through on the strategy that I like to use. And that's pretty much all I got. All right, that was it. What do you think, Mo?
That was really good, man. I think I've been saying that this market, you need to add more tools to your tool belt, and knowing covered calls. And then I know you're looking at vertical spreads too.
Yep.
All those will help just make you a better trader, and you're going to know what tool to use in what kind of market condition. So I think it's very good to diversify your toolkit.
Yes. And if you guys have any other question or anything that you feel like I missed on cover calls, or if you have any questions about cover calls, please comment below in the comments. I do check them. And maybe we could do it in another follow-up video. I could answer some of those questions that you guys may have. So over to you, Mo. What's on your docket?
All right, so I wasn't planning on doing this presentation. I actually had someone from come up, message me on Twitter saying that you need to do something for risk management, and that's the cool part with us. You can tell us what you want to see, and we will create it on-demand content. So if you like what Mark's doing, but you want the content in more detail or less detail, you just have to comment, and we'll get that done for you. And the fact that we do it every 2 weeks gives us the time to have a thorough approach. And that's why we do this. All right. So what I want to talk about today is risk management. Mark, do you know? Okay, perfect. So what I want to talk today is risk management. So it says risk management is the biggest technical indicator. And the reason why I say that is this is the only thing you can control. My goal here is to change the way you think when it comes to trading, because a lot of us see trading as one way to make some side money. But I think what we need to see this as a full-time business. Even though you're putting in 4 hours every 2 weeks or 8 hours or 40 hours, you need to treat this like a business. Every business has an SOP. They have a description, a job description. It has limitations. So what time do you start? What time do you open? What time do you close? So all that stuff happens in a business. But when it comes to trading, we don't see that with people. So let's get into it. So these are my risk management rules. The first one is pay yourself. What I mean by that is every single week that you make money, once you are a profitable trader, make sure you make a system where you are paying yourself. And the whole point behind that isn't that you need money. It's more to you're training yourself, like how you get paid in a job every 2 weeks or every week. You're doing the same thing. So you're telling yourself that you need to make money, and that money is only money if it goes in your saving checking and you actually do something with it. Invest it, spend it, that's up to you. But the money has to have some use for it. The reason why I bring it up is over 2020 to all the way now, I've seen a lot of people build their portfolio 100x, 1000x only to give it back. And they never took money out. So when they were position sizing, they were pretty much taking in the entire position, and they were getting too comfortable because they had so much money in the account. Like for someone who had 500, took their account to 5,000 or 10,000, they kind of started getting reckless because they saw that they can do that. They have the ticket to do that because they've taken their account and they're untouchable, which is why I think it's very crucial to take money out of the account. You can set a limit that you're going to take out, or you can do a percent. So if you made whatever X amount, you'll take 50% out and maybe invest it, maybe do something else with it. Like I would even encourage put in a separate trading account if you want to trade with it, but I wouldn't have all of it in one account. You're again subconsciously training yourself that the money needs to go to your bank account. What I see a lot of people do is putting money again and again from their checking account into trading account after blowing up their account. That also becomes a bad habit, so you want to stay away from it. The next one is focus on base hits. What I mean by that is there's times where you are going to hit 3, 4, 5, 10x, but if you're always thinking about that or that one occasion where it happened, your brain will never be happy for the 20, 40, 50% gains that you're doing. And eventually the lack of gratitude will lead for you to increase either your position size or risk tolerance. So the way I look at it, 80% of your profits will come over 20% of trades that you make throughout the year. But the 80% trades that you're making, their job is to teach and give you the base hits and you to survive the market while you look for better plays. And when I say look for better plays, I don't mean you size heavy on it. I mean more so that you're alert and you actually identify that these plays could do better than what other plays are doing. And those we call A+ setups, which we will go at some point in our time here. The next one is probably the biggest one. I'm taking this straight off the book, Trading in the Zone. and it's accept and acknowledge predefined loss. A lot of people get disheartened when they lose money. What people don't understand is when you get in a trade, there's an opportunity cost, which is your predefined loss. If you're getting into a position, let's say, and you put in $500 into it, you need to mentally be ready how much you're willing to lose. So let's say you're saying I'll lose about 20%, that's $100. That is your opportunity cost of making the trade. Now, if you don't lose, if you get in a trade and you lose, all of a sudden you don't expect that outcome, it's going to ruin your mood. And that's how people get into over trading, revenge trading. So you need to accept that predefined loss. I often say stop losses is the cost of doing business. It's not a bad thing. If you get stopped out, it's to protect you. It's part of the system. You move on to the next trade. The next one is most people that have an issue with deciding how much money they need to put in terms of position size. An easy formula is whatever you have in mind, especially when you're new, half the number of contracts that you're putting in, but double the time. So if you were thinking, I'm going to do 6 contracts for this week, you're better off doing 3 contracts for next week. It gives you more room because most new traders aren't used to the volatility. That's kind of how I used to decide. A lot of this presentation is about setting up fundamentals. If you have been trading for 10 years, half the rules might not apply to it. But if you've been doing this since 2020, 2021, consider this approach. Maybe try paper trading and you will see that you'll be a lot more calm. And that's what I focus on. If you make money, but you're always stressed, you won't be able to last in this trading career. That's why you see a lot of people that used to trade in 2020, they don't trade anymore because they got exhausted. And once you get exhausted, first your mental capital gets exhausted, then your actual capital. So that's what we focus on. The next one is pretty basic, but most people don't follow it. Set rules and trade like a system. What does that mean? If I'm getting into a trade, I should have that trade prepared at least on the weekend or know something about it. I need to know my entry, my stop loss, my profit taking, and what is my why for getting into the trade. So if my trade is to, let's say, trade for FOMC and I'm down 10% on Monday and I sell it, it didn't satisfy the why. So make sure you have all that in place. If you're someone who does mental stop losses, if you're following through, it's fine. But if you're not following through, you know that approach isn't working and you need to actually put in the stop loss when you're entering into the system. All right, this is huge. And I know a lot of people don't do it. So I bring it up again and again. Your number one goal in trading, or I say my number one goal, is to make my position free. What do I mean by that? If I put in $500 in my trade and I'm up another 500, the first thing I'll do is sell half. So one of my rules is anytime I'm up 100%, I sell half. I don't care if the play can go to 2000%. My job is to make sure I take my capital out first. And let's say you're up 40% and it's a weekly swing. You can sell enough to make the trade free or lower risk. That's just part of managing the risk. The next one is when you enter a trade, always know and accept and acknowledge how much you're willing to lose. What I mean by that is a lot of us, when we first started, we entered the trade, we would look at the direction of what we bought. So if we bought calls, we'd see how high it could go. If we bought puts, we'd see how low it could go. What that does is you're training your mind and your brain to only think about the upside. And when the upside doesn't happen, downside happens, you get a reaction, which is emotional, which often leads to, again, revenge trading or over trading. So when I get into a trade, I don't think how much money I can make. I think of how much can I lose. It goes back to the predefined loss part. The next one, which I've covered over, is your emotional capital is bigger than your capital. So yes, you can play 0 day and make a 400% trade. But if you maybe, let's say another week, would that be easier for you to hold? Because a lot of people will play 0 days and be like, I sold too early. This thing went 300%. I took 100%. Most people, what they don't understand is you have no control on how high it could go. So whenever you're comfortable taking profit, that's the right time to take profit. If Mark holds it longer than me and makes more money, that's because Mark has a different risk tolerance and he's got a different skill set than I do. I cannot compare myself to Mark. Whenever you sell in profit, that's the good time to sell. Yes, you can gain more skill to hold it longer, but if you're not okay and you're not calm, maybe you did it this one time, every other time it's just going to cause you more anxiety and the side effects will come after. The last one, take emotions out of the execution. One of the things that I did, and I've talked about it, I stopped looking at profit loss when I was trading. I would be in the order entry box where it would show. And so I didn't like the green red. It would cause me anxiety. Now it's fine. I know some people, they'll put like a sticky where it shows their profit loss, so they don't like looking at it. And that's fine too. It's whatever makes your life easier. Think of this. If I was telling you whatever job, whatever business you're doing, would you be happy if nothing changed? You did the same thing for 10 years? And if the answer is no, you want to make changes now. So the answer becomes yes, right? All right. Let's go back. Okay. Okay, so we're going to go over an example and I will go over why most people do this and why it's a disastrous way of trading. So we'll call this person Alan. And this is how they did their goal setting. Their goal is to take profits on each play at 25. Their stop loss goal is 10%, and their daily target is to make $500 a day. This is sort of what their game plan is. You can call this is what their SMART goal is. This is what their objective is for trading. The reason why this doesn't work is Alan could be in a play and they are up 22%. And they say, I'm going to wait till 25% and take profit, and the market turns right at 22%. When I say turn, the market goes against them. The reason why this will happen is because this has no correlation with the market. Market doesn't care about Alan's 25%. Market watches levels, watches news. That's what the market reacts on. So I tell people, be very careful if you're setting your profit target and stop losses on a percent. When it comes to stop losses and you say, this is the most I'm willing to lose, let's say it's 50, that's fine, but you still need to watch levels. But when it comes to profit taking, if a news came, you don't need to rely on 25%. If you do that, you most likely will take all your green trades into red because you were holding for a whole number or a specific number. So always watch levels, tape, flow, whatever you're comfortable with. That is aligned with the market. Setting these numbers, arbitrary numbers, won't do anything for you. The next one is my daily target is to make $500 a day. This does two things. A, you're putting a price on your learning. So instead of focusing on the process, now you're focusing on a dollar amount. What happens when one day there are no trades based on your skill set? I'm not saying the market's trash. A lot of people that blame the market take no accountability. I'm saying your skill set haven't prepared you to take trades in that market. So it's you, which is fine. But if you say my goal is $500 and you don't get to $500, what do you think is going to happen? A couple of things. You could feel like you're not doing good as a trader, but in fact, you actually did amazing because even though you made $100, most people went to red or it was the market was very tough to play. Second, you start over trading and what you end up doing is losing money. And third, you do revenge trading. So that's why you don't want to set daily target. I don't think that's a smart thing. I think it's a way to put pressure on yourself. More pressure causes more emotions, causes more mistakes. You want to trade emotionless? This is what you do. You follow your execution plan. That's your daily goal. So if Tesla goes under 205, I will short and buy 200. That's an execution plan. Your goal is just to execute that. Your goal is not the outcome, which is money. It's the process. Okay, so this is a pretty interesting chart, and this assumes that you're basically taking the entire account and putting into the market. So if you are down 10%, it only takes an 11% green day for you to break even. Okay. However, if you're down 40%, you need to make up 67% to break even. As these numbers go lower, the amount of money you need to make up goes significantly higher. So if you are down on your portfolio by 70%, you need to make 233%, not to be in profit, to break even. Very important chart. I would recommend you screenshot and write it down somewhere. And this is why I think stop losses are important. A lot of people get really defeated when they get kicked in, and mostly it's 0 days where you get kicked out and the stock runs. And my only thing to say to that is stop loss's job isn't to make you the most money, it's to protect you. It's insurance. It's not something that's going to get you 1,000% trade. It's to make sure you don't lose what you have, and you decide how much you're willing to lose. Okay, so this is for people that sometimes get mesmerized by all the big gains people post. I just want to give you a reality check. This is what comes down to when you make little profits at the end of the year, and it compounds. And this is what I mean by base hits, and this is why it matters to show up every day and trade with a plan. So if you're making $50 a day, you're making 12,600 a year. If you're making $500 a day, you're making 126K. All of this is still a lot of money. If you didn't have it, it's zero. Even extra $12,000 a year in this kind of economy can do wonders for you, your kids, or your family. Okay, so here is why comparison is toxic. I want to give you a specific example so there's no confusion after that. Mo has $20,000 capital, risk tolerance is 10%, where we have Ben, $5,000 higher risk tolerance. Here's another thing I want to cover. I do a lot of one-on-ones with my mentorship students, and when I take new people, I always ask people what your risk tolerance is. And I'll give you a quick example. If I have $50,000 in my account and Mark has $5,000, and you ask me, Mo, how much are you willing to lose? And I say, I don't want to lose more than 5,000. I'm not going to trade with 50K. I'm going to trade with 5K because that's the most I'm willing to lose. Whereas if you talk to Mark, he said, oh, I have 5K. I can lose it all. It's like my play money. We both, even though we have different account sizes, our risk tolerance is the same. That means we play in the same rules. Just because I have 50K doesn't mean that I can take a heavier risk because my risk tolerance is low. So always look at what's your risk tolerance versus how much money you have. You could have $1 million, but if your risk tolerance is 1%, you don't have $1 million, you have $10,000. That's how you have to think. So this is why it's important to know what kind of trades to take, how much capital you want to assign. So the person that has 20K most likely should only be paying 2K. And the person who has a 50% risk tolerance should be their total capital they should be playing with. Mark, do you have any questions or anything that you'd like to add?
No, man, it's really good. I'm going to add some stuff. All right, is this it?
Nope. Okay, so here is an example. And this example is specifically for scaling. A lot of new traders, when they start, they basically buy everything at one point and sell everything at one point. Here's an example of how scaling can take the risk off the table as well as make you more money. So this guy Mo bought 50 contracts a spot, entered at 1, got out 148. He made $24 for the day, 48% profit. Nothing wrong with it. That's his style, but he doesn't scale in or out. He just buys and sells whenever he feels comfortable. Now we've got Ben, who's much of a smarter trader than Mo. He actually got less contract and he started to scale. What he did was he took his first exit out at $1.50, right? So he made 50% profit and he got out for 5. The rest 5, he made 100% profit and got 1,000%. The third exit, he made another 5 at roughly 150% profit. And then on his 4th exit, he sold them at 300% profit per approximately, and he made 1,000 on that. Believe it or not, this is literally how I trade and how I've been taught to play. If you ever see any of my trades, it's like this: 1 layer, half size, 2nd layer, 3rd layer. It's because you're taking risk off the table and you're letting the little capital that you have to work really hard for you. And this is an example. This person made almost double the profit I made with half the size. So they ended up making 4 times profit than this person Mo. This is why scaling works, and it's very important. It's actually less risk. All right. I think this is it, Mark. Feel free to add more if you like, but I'll do more of this too so people get a general idea with real life examples.
You know, that was really good. And I want to again emphasize and tell people we're not encouraging people to go out there and trade recklessly, right? Because Mo, I guess you agree with this, right? Why do you think there are more people who are successful at investing than trading?
Because you don't have to use a lot of emotions when you're investing, and you have a long time horizon, so you're not micromanaging your trades. You know, everything gets complicated when we get involved, our emotions get involved, and when you are trading, you micromanage. You have to, especially if you're doing weeklies. And a lot of us, our emotions are such that cannot handle the volatility, and then again you're checking what Mark's making, what we're checking what Lawrence is making, and now we're comparing, right? And we're not happy. And when you do long term, you just buy. It's a system. Your dollar
Yeah.
cost averaging, every once a month you buy blah 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 whatever it is. When you get paid bonus, you buy a little bit more. Are you timing the market? No. Maybe Mark, you know a lot about technical now, so you're like, yo, I'm not gonna buy. This is overbought right now, or this is almost overextended. And you could say, okay, I'm gonna hold off here. That's the only thing you can do with extra skill. But in investing, it's very automated. And in trading, you can only automate so much, which is, I say, whatever you can automate, make sure you're very strict about it. So that's why I think most people lose.
Yes, and I agree. And that's the reason why I asked that question is in short, investing is a lot easier than trading. It just is because of the emotional factor. It's not that you can't be successful at trading, but there is a reason why the emotions and attachment to money and the psychology of money plays a huge factor in the trading business. Also, we saw a bunch of nice numbers that Mo put up there. Okay. The last thing I want is for people to get their refund checks and start putting it in the market and trying to trade full time. For the love of God, please practice. Like, start from the bottom on up. Mo met me. I think I wasn't a terrible trader, but I wasn't a consistent trader, right? When you first met me. And the biggest issue that I had was my emotions, correct?
Yeah,
It still is.
Yeah,
It
I
still
don't
is.
think you have any skill issues. It was more emotions, and I think we talked about it.
Yes. And as we continue with this show, you will see other people who will come on this show. We will bring on some other traders on this show who are, for example, futures traders or just stock traders. So one of hopefully our next guest is actually a stock trader. So does completely different than what Mo does completely different than what I do, than what Mark does, than what Lawrence does. Very different. There's multiple different ways to basically skin a cat. You need to find out what works best for you. But first and foremost, you need to understand money and you need to be financially set prior to getting into this space. And I think too many people, especially a lot of content creators in 2020, everyone made it seem like this was very easy. And that's the reason why I'm just kind of mentioning it. It is not as easy as taking $500 today from your refund check for your taxes, and then you're going to be a millionaire tomorrow. A lot of
Yeah,
people blew
the
their
thing
accounts
is,
in 2020.
that's the red flag to Mark. Like, I know there's someone in the group posted that they made in 3 months they took 500 to 5K, but I can tell you, you can go talk to the person. They took like 1 or 2 trades every week, and they've been trading for 4 years, so they have the skill set. And I can promise you that guy wasn't looking to take his account from 500 to 5K. He was just compounding. The ones
Yep.
that have the 500 to 5K mindset, they are the first one to blow up because they're not grateful with the 40-50% return. They're looking for those big hitters. There's very few people I know that can do that without having any emotions, and their risk tolerance is usually crazy. Like,
Yeah.
the lotto on Fridays.
Yeah, all those crazy stuff. And I just want to put a disclaimer out there because, again, like this, our overall goal here is for everyone to win, and we don't want to lie to you. We want to be transparent, and the ultimate goal is for you to learn this skill, but take it slow. And like Mo said, the compound effect. It's okay. Like, if I could go back in time, and I said that in the video I just did. If I go back in time, I wish I had learned about cover call, cash secure puts first, and then go to verticals, and then go to puts and calls, which Mo does, and then go to leaps, and then go to futures. That's how I wish I had done it to begin with. I did a complete opposite. went from the top on down, which is really crazy. But there's ways for you to make money out there. But first and foremost, please be an investor and don't put money in a market that you do not have to lose. And that's even on the investing side as well. Like Mo said, we're going to have a whole episode about the whole 9-to-5 gimmick that's BS. You need to quit your job and blah, blah, blah. We're going to have a great conversation on that in another episode. But yeah, that's pretty much all we got today. Right, Mo?
Yeah, I was just one thing I want to add. There's the reason why I covered risk management apart from the person recommending it. There's 3 parts to be a good trader or even a good investor. Technical analysis is one, which is mostly for day traders. If you're an investor, you do technical and fundamental hand to hand. The next one is risk management, which we covered today. And then the third part is trading psychology. What I think in this world that we're in, technical analysis gets pushed the most. The other 2 aren't really talked about. But if you had to pick the most important one, it's not technical analysis.
So risk management.
Yeah, it's risk management, then it's trading psychology, and then it's technical. If you don't have the last 2, technical is just you'll be a great teacher. You might be a great analyst. You won't be a great trader because you know what the right thing to do is in terms of technical, but when it comes to actually doing it, you won't be able to do it because the other 2 things aren't managed.
100%. And I had no risk management skills when I met you, Mo, 2 years ago. And that's when I really started building my foundation of risk management, and my losses got less and less and less, and my wins got bigger and bigger and bigger. So yeah, it's please rewatch this video over and over if you can, especially with the cover calls. If you have shares that are over 100, and of course, if you're interested in getting into the trading game, please watch that risk management part that Mo covered. That's first and foremost what you should do before you do anything else. So, but yeah, you got anything else, Mo?
Yes. Make sure you guys leave comments on what you like to see, what you like, don't like, what you want added. Because again, I think me and Mark are very flexible. Instead of me creating content that I think you guys would like, I would love to do things that you guys want. So that's what I would love to do.
Yeah, absolutely. And if you're ever interested, because we haven't done our lunchbox yet, we're going to start doing that here soon. Probably when I start buying more shares, or if Mo sees a good A+ setup that he thinks would benefit the community. If you're interested in like levels and stuff like that, by all means, definitely DM me on Instagram. Again, you can find me on Uncultured Currency. It's together. There's no underscore. There's no dot. Those are all those fake accounts. It's just Uncultured Currency. That is it. On Twitter is Uncultured XE. Mo, where can they find you again?
So on Instagram is OTB Clubhouse, one word. And on Twitter is OTB Shark Mo, all one word as well.
Yeah. And of course, you guys can also find me on my personal YouTube channel, Culture Currency. I actually dropped a pretty good, interesting video about the whole Grant Cardone thing, but I don't want to bring any drama to this group. So, but check it out if you want to. There's some interesting stuff that's going on with that guy. So,
Mark, I want to add one thing when you're done. Sure. I forgot about it.
Go ahead.
So I wanted to let you guys know a big flow that came, and I'm going to do that time to time. This is stuff that's very important. Someone added 5,000 puts for March. So 5,000 meaning they went in the money, and they were added for 86 million. You heard me right. It's a $86 million opening SPY put position. It's not a spread. It's a straight opening position. You can say it's a hedge. It's one of the biggest hedge I've seen this year. And then you've got a 100 million. No, now it's 50 million position by Carl Ian that he added. I believe that is for 39.50. So in total with these two positions, that's about $130 million for March in puts.
You're making me nervous there, Mo. My beard may turn a little bit grayer. This is hey, but guess what? It's buying opportunity for all the investors out there, right? Well, like, hold on. Before I say that, because I don't want to be like everyone else. It's buying opportunity. A year and a half, the market's been selling off. So I'm going to be careful with that, okay? It may not be a buying opportunity right now. Just wait, be patient, okay? I'm sounding like all those other people. It's buy the dip. 1 year and a half later, buy the dip. It's like, dude, I ran out of money. I already bought all the dips I could buy. So, yeah. All right, guys. Until next time, make sure you guys subscribe. If you're brand new, definitely give us a thumbs up and share this video. And see you guys in the next 2 weeks, which we shall hopefully have our special guest on. We'll announce it when we put out the flyer. So until next time, peace out.
That's 100.